Hey guys, this morning tonight, whenever you're watching this, we're talking about JPMorgan, the man who turned panic into power and helped shape the financial system you're still operating inside in 2026. Here is the blunt version. In a crisis, money doesn't vanish, trust vanishes, and whoever controls trust controls the economy. One quick note before we go in. If you didn't watch episode 1, Rockefeller built the system you can never escape. That episode explains the method of building a system you can't easily leave. This episode is what happens when that method climbs upstairs into money itself, because once the method touches credit, it stops being business history and starts being your monthly payment. Now picture New York, 1907. Rumors spread faster than facts, people line up outside financial institutions, and what used to feel permanent suddenly feels like paper. This is the part most people misunderstand. Banks don't keep your money in a neat little box with your name on it. They keep a fraction and lend the rest into the economy. That is why even a 10% rush for cash can turn safe into closed in a single afternoon, and in the middle of that chaos, there's a closed room, not a courtroom, not Congress, not the market, a room with a lock, a few men, and a table where names get sorted. Morgan makes 2 lists, who gets oxygen and who doesn't. 1. Name crossed out isn't just one company dying, it's suppliers, payrolls, inventories, and loans that stop rolling over. One name kept alive isn't just a rescue, it's a signal to everyone outside that someone still has their hand on the steering wheel. Here's a deadweight detail that should make you uneasy. On October 22, 1907, the Knickerbocker Trust got hit with a classic run, and about $8 million was pulled in less than 3 hours. That's not a dip, that's people grabbing the doorknob at the same time, and when the crowd moves like that, the system doesn't debate morals. It checks liquidity. The scary part isn't that Morgan had money. The scary part is that he could decide when money would act like money again. A single commitment in that room could flip the street outside. An $8.25 million loan arranged overnight could keep doors open one more day, long enough for panic to cool by half a degree. The Treasury drops about $25 million into banks to shore up confidence. Another $10 million comes in as a high-status signal from Rockefeller. None of that is magic, it is psychology-backed. Buy cash because the market is a creature that doesn't need a reason to stampede, it just needs permission. So here's the twist, and it matters. Morgan didn't need to buy every company. He bought the right to decide in the moment everyone was most afraid. That moment teaches the system a rule it never unlearns. If you want to survive a crisis, stand close to the center of liquidity. When people talk about too big to fail, this is the ancestor, not a law, a habit. And yes, this is still your life in 2026. The Federal Reserve's benchmark rate right now sits in a 3.5% to 3.75% range after a quarter-point cut on December 10, 2025. The prime rate banks quote off that is about 6.75%. This isn't trivia, it's the price tag on your patience. Even mortgage rates about 6.06% on a 30-year fixed as of mid-January 2026 decide whether a door opens or stays imaginary. Here's a simple way to feel it in your bones. If your rate moves 1 percentage point on a typical 30-year mortgage, the difference can easily be a few $1,000s a year in payments. Depending on the loan size, that's groceries, that's childcare, that's whether you save or you tread water. People argue politics and personality, but the system speaks in basis points, quietly, relentlessly. So what are we actually talking about when we say the financial system? It's not Wall Street, it's not just banks, it's a network of credit, liquidity, and trust woven so tightly that you can't tug one thread without shaking the rest. Whoever coordinates trust coordinates the economy because everyone else is making decisions in the dark. That's the core idea you should keep, even if you forget every name in the story. Morgan's playbook is 5 moves, and I'll keep them human. First, trust is currency. Being believed is what keeps you alive when the cash gets nervous. Second, a backstop. Someone has to stand behind the system and say you will get paid, or the stampede doesn't stop. Third, triage. Not everyone gets saved, and pretending otherwise is how systems die. Fourth, consolidation. Fewer decision points make future rescues easier, and easier rescues make power more central. Fifth, legitimacy. The power eventually gets dressed up as the public good, because raw private control is hard to sell. Here are the 3 promises I'm making you for the rest of this video. 1. Morgan builds the chair at the center, even before the government admits it needs one. 2. Every crisis makes the system more concentrated, not less, because panic rewards whoever can backstop. 3. By 2026, you can see the Morgan logic everywhere once you know what to look for, not as a conspiracy, as a structure. And here's why this isn't just history. Whoever holds credit decides who lives and who dies economically. A credit line renewed is oxygen. A credit line cut is suffocation with paperwork. Crisis doesn't only destroy, it redistributes power, because the weak are forced to sell, merge, or beg for terms. If you understand backstops and consolidation, you'll understand why bailouts always come with conditions, why stability often means someone got control, and why the bill is usually paid by people who weren't in the room. Quick educational note, because this part can actually help you. In the US, the rules around deposit insurance and banking safety exist precisely because runs are a feature of human fear, not a bug in math. If you're parking cash, know what's insured, know the limits, and don't confuse an app interface with a guarantee. And if you're borrowing, read how your rate resets and what triggers a repricing, because the contract is where the system touches your kitchen table. So who was Morgan emotionally? He was a boardroom general, disciplined, severe, allergic to chaos. He treated disorder like a moral failure, not a normal phase of markets. The pivot is uncomfortable. He didn't believe stability was a nice to have. He believed stability was virtue. Competition was fine until it threatened the plumbing. And once you believe that, the next step becomes easy to justify. When panic hits, society needs someone everyone trusts, even if that someone wasn't elected and never asked permission. History then hands him the perfect stage. The Panic of 1907 doesn't start as a philosophical debate, it starts like most meltdowns do. A rumor, a failed scheme, a sudden loss of confidence, and then the mechanical sound of withdrawals turning into a sprint. Trust companies and banks get squeezed, the lending market tightens, businesses can't roll short-term debt, and the economy starts to freeze from the inside out. Money didn't disappear, it just stopped moving because nobody wanted to be the last person holding someone else's promise. That's the knife-edge moment when the system can't breathe. The one who can provide oxygen also gets to set the price of oxygen, and that's why Phase 1 matters, because Morgan doesn't merely stabilize the panic, he concentrates the right to decide who gets stabilized. In the next segment, we walk into the private backstop, the locked room, the audits, the guarantees, the signals, and the quiet part nobody likes to say out loud. Rescue doesn't just stop the fall. Rescue chooses the winners, so Phase 1 is the private backstop, and it's way less mystical than people make it sound. A backstop is just the person everyone believes will catch you when the floor drops, so you stop running before you trample each other. In normal times, nobody needs a hero because liquidity is boring and automatic. In panic, liquidity turns personal because you're not asking what is this worth, you're asking will I be paid today. That's when the system starts looking for a single voice it trusts, and that voice becomes the lever. Morgan's first move is brutal and simple. He controls the room before he controls the money, lock the door, cut the noise, force decision-makers into one place, and remove the option of hiding behind delay. He didn't calm the crowd by giving a speech to the crowd, he calmed the crowd by making sure the people with cash couldn't pretend they didn't have responsibility. Then comes triage, and this is the part that feels like a thriller because it basically is one. Someone's books get examined, someone's collateral gets weighed, someone gets judged as sound enough to save or too messy to touch. If you think that sounds unfair, you're right, but you're also hearing the real rule. During a run, purity loses to speed. The numbers tell you why this is so violent. In 1907, trust companies were holding cash reserves around 5% of deposits, while national banks were holding something like 25%. That sounds like a footnote until you remember what a run is. A demand for cash right now from an institution that never promised to keep all the cash right now. The Knickerbocker Trust gets hit, and after depositors pull nearly $8 million, it suspends operations. The message that lands on the street isn't Knickerbocker is complicated. It's your money might not be there when you arrive, and once that sentence exists in the air, it starts walking into other institutions. Then the credit market sees up in a way that makes modern people think of a circuit breaker blowing. Overnight lending rates that are usually single digits spike like a heart monitor, jumping from under 10% to 70% in a day and then up toward 100%. At points, it's not even about the price. There are moments when nobody wants to be the lender at any price. That's the meaning of freeze. It isn't that cash doesn't exist, it's that trust has stopped translating promises into transactions, and when the translation breaks, payrolls and supply chains become hostages to a psychology problem. This is where Morgan's for moves play out like a machine. He isolates decision-making, he sorts institutions into categories, he arranges guarantees and emergency loans, and then he broadcasts a signal so the crowd understands the system still has a pulse. There's a reason stories keep returning to the image of cash being delivered directly to the New York Stock Exchange loan post to keep brokers funded. It isn't romantic, it's a message. It says someone is still willing to be last, and once people believe someone else will be last, they stop trying to be first. But here's the cold twist, the one people avoid because it ruins the fairy tale. Rescue doesn't just stabilize the system. It also chooses the winners. When you backstop some institutions and not others, you aren't only preventing contagion, you're also redesigning the map of power. The institutions that survive a panic don't just survive, they absorb talent, customers, and deals at fire sale prices. The ones that get left out don't just fail. They become cautionary tales that push everyone else to cluster closer to the center next time. If you want a practical lesson that stays legal and sane, it's this. Never build your personal finances around the assumption that credit will always be available. Keep an emergency cushion, understand what's insured and what isn't, and don't confuse I can sell it with I can sell it fast during panic. Phase 2 is consolidation, and Morgan understood it like an engineer. Chaos creates 1,000 nodes of risk, each one capable of failing on its own schedule. Mergers turn 1,000 nodes into a few thick cables, and thick cables are easier to monitor, easier to fund, and easier to rescue. That's the formula, and it sounds almost too clean. Panic creates weakness, weakness forces deals, deals reduce the number of critical decision points, and fewer decision points mean control becomes cheaper. People at the time even had a nickname for it, Morganization, because it wasn't just buying. It was restructuring the entire organism, and this is where the audience reaction gets complicated, because you can't deny the efficiency. Morgan helped assemble massive combinations before 1907, and they became templates for what modern corporate power looked like. General Electric is formed in 1892 from the merger of Edison's company and Thomson Houston, and the deal is associated with Morgan's influence. U.S. Steel is created in 1901 by merging Carnegie Steel with other producers, and it becomes the first billion-dollar company in American history. In each case, you can tell two stories that are both true. One story says consolidation is progress, scale lowers costs, standardizes output, and makes the machine run. The other story says consolidation is domination, fewer gatekeepers means fewer exits, and the people closest to the gates write the rules. After 1907, consolidation isn't just an industrial habit, it becomes a financial survival strategy. When the next shock hits, you want to be the institution that can access the backstop, not the one standing outside the club. That incentive doesn't require conspiracy. It requires memory. Every executive remembers what it felt like when nobody answered the phone. They reorganize so next time someone will. The educational angle here is quiet but important. If you're a consumer or a small business, consolidation changes your options without announcing itself. Read fee changes, watch for service updates, and don't be shy about shopping around legally. Because your leverage is highest before you're desperate, not after. Phase 3 is legitimacy, and this is where the story stops being a Wall Street legend and becomes a national blueprint. A system that needs a private room and a private man to survive is basically admitting it has no public safety gear. The panic makes that obvious. And once it's obvious, people want a mechanism that doesn't depend on whether a single financier is alive, willing, or in town. That's why the aftermath isn't just gossip, it's legislation. In 1908, Congress passes the Aldrich-Vreeland Act, which creates a way to issue emergency currency and sets up the National Monetary Commission to study banking reform. In 1910, a small group meets in secret at Jekyll Island to draft a plan to reform the system, and secrecy matters because legitimacy is fragile when the public thinks bankers are writing the rules for themselves. Then the United States makes the private logic official. On December 23, 1913, the Federal Reserve Act is signed into law and a central bank structure is born. The idea is simple enough to say in one breath: backstops should be standardized, not improvised. Liquidity should be coordinated, not begged for. And panic management should be a function of a public system, not a private rescue. If you want the civic version of the practical advice, it's this. When you hear the words stability and reform, always ask who gets more discretion afterward, not because reform is fake, but because every reform changes the shape of power as well. As the safety of the system, now comes the plot twist that makes the whole thing feel inevitable. The Federal Reserve is created to prevent a Morgan-style moment from being necessary again, but the logic Morgan proved doesn't die. It gets institutionalized. Crisis hits, the backstop expands, and the center grows heavier. The system learns again and again that the fastest way to stop a stampede is to concentrate the authority to say, yes, you will be paid. That authority can be public now, and that's an upgrade in many ways, but the gravitational pull is the same. The center becomes the story because the center is where survival gets decided. And as we drift toward the present, you can start seeing why this matters in 2026 without turning this into a lecture. Interest rates aren't just an economic statistic. They're a distribution mechanism. When the benchmark moves, some people get oxygen and some people get thinner air, and it happens quietly through payment schedules and lending standards. If you want one clean, lawful habit that makes you harder to hurt, it's to stop reading rate decisions like background noise. Understand whether your debt is fixed or floating, know how quickly your expenses respond to rates, and don't gamble your life on the hope that cheap money is a permanent feature of reality. So that's the arc. A private backstop teaches the system where the center is, consolidation makes the center easier to control, and legitimacy turns the center into public plumbing. But the emotional punch is the same as the one we started with. In the moments that scare everyone, the person or institution that can restore trust becomes the steering wheel. In the next stretch, I'm going to hit you with the modern montage because once you see the blueprint in 2026, you can't unsee it. And that's when the uncomfortable question shows up. If the system is the center, what does that make you? Right here is the part where people expect a happy ending, and they don't get one. America builds the Federal Reserve to stop the next 1907 from needing a private library and a private kingmaker, and that's real progress. But the deeper logic survives because it's not a personality trait, it's gravity. When panic hits, the system looks for a center. When a center exists, everything starts orbiting it. So let's talk about the present tense because tonight is always the real setting of this story. As of mid-January 2026, the Fed's target range for the federal funds rate is 3.5% to 3.75%. That sounds clean and technical until you remember it's the starting gun for the price of money everywhere else. The prime rate that banks quote off that is 6.75%, and the average 30-year fixed mortgage rate is sitting around 6.06%. Those three numbers are basically the weather. You don't argue with weather, you either dress for it or you get sick. Here's the Morgan blueprint in 2026, and I am going to hit it fast like a montage because that is how it feels when you finally see it. 1. Backstop. The modern backstop isn't one man. It's the central bank, deposit insurance, emergency facilities, and the implicit promise that the pipes won't be allowed to freeze completely. 2. Consolidation. Every crisis has a weird side effect. It doesn't just break things, it merges things. The weaker players get absorbed, the bigger nodes get bigger, and the next rescue gets easier because there are fewer critical doors to knock on. 3. Invisible pipes. Repo markets, clearing systems, collateral chains, money market funds, all the plumbing most people never see until it gurgles. 4. Information advantage, guidance, press conferences, dot plots, forward expectations, the ability to move the crowd without moving a single dollar at first. 5. The stability story, the same moral argument repackaged. This isn't about winning, it's about keeping the lights on, and the motif is the same, even if you change the costumes. The system is the center. When the center speaks, markets move. When the center hesitates, markets invent their own ending. Now if you're thinking, okay, so we're safe now, we have a central bank, we have rules, we have guardrails, that's where the trap closes. Safety mechanisms reduce the chance of total collapse, but they also make the center more important because the center becomes the official distributor of oxygen. That's why modern crises often end with bigger balance sheets, bigger guarantees, and a tighter relationship between money and policy. For example, the Fed's balance sheet right now is around $6.58 trillion. That isn't just a number, it's the weight of the backstop. It's the proof that in an emergency, the center can expand. Here's the educational part that people skip because it doesn't feel cinematic. If you live in the US, don't build your life on vibes about the economy. Track 2 or 3 practical indicators and treat them like basic hygiene. Know where your interest rate exposure is, meaning what parts of your life get more expensive when rates rise. Know which accounts are insured and what the insurance limits are. And if you're a small business owner, understand your cash conversion cycle, because short-term liquidity problems are how perfectly healthy companies get forced into bad deals. None of that is rebellious, it's just responsible. Now the uncomfortable question, where do you fit in this structure? The honest answer is you operate inside it. Whether you like it or not, you can quit crypto, quit stocks, quit watching Bloomberg, and it won't matter, because the system isn't your portfolio, it's your price of capital, it's your landlord's financing cost. It's your employer's line of credit, it's your city's bond payments, it's the invisible interest meter running behind your entire life. Let me make it painfully tangible. On a $400,000 30-year mortgage, a 1 percentage point increase in rate can cost you about $3,164 more per year in payments. That's not market volatility, that's your calendar changing, that's vacations, repairs, savings, and options quietly bleeding out. When rates fall, it feels like relief. When rates rise, it feels like the walls move closer. And the wild part is most people blame themselves for that pressure, when it's literally just the price of trust changing. This is why the phrase credit decides who lives and dies isn't dramatic, it's descriptive. The person with a fixed rate and stable income can float through turbulence. The person with variable debt and thin cash buffers gets hit first. The company that can refinance survives. The company that can't refinance gets strategically restructured, which is a polite phrase for being forced to sell the future to pay for the past. So what's the trade-off? The benefit of a strong backstop is you avoid a chain reaction collapse where healthy people get crushed by other people's fear. That matters. It prevents a lot of innocent damage, but the price is always the same. Rescues come with conditions, and conditions concentrate power. Stability is never free. Someone pays in dilution, in regulation, in lost competition, or in the slow reality that the center becomes harder to challenge over time, and that's where your moral twist shows up, because it's not clean. If the backstop prevents collapse, you want it. If the backstop makes the center more powerful, you fear it. If consolidation makes services efficient and accessible, you enjoy it. If consolidation reduces real choice and lets gatekeepers set terms, you hate it. You can hold both feelings at once. That's not hypocrisy. That's adulthood. Now, what do you do with that? I'll give you 3 options, and none of them are pretty, so pick the one that matches your values instead of pretending you don't have any. 1 is acceptance. You stop romanticizing escaping the system and you focus on surviving it intelligently. You pay attention to rates, you reduce bad debt, you build a buffer, you diversify where you keep your money, and you stop assuming tomorrow's liquidity will be identical to today's. You don't have to love the system to be fluent in it. 2 is resistance. Real resistance in America is not about fantasies or illegal nonsense. It's boring, lawful, and frustrating. It's supporting competition policy, caring about transparency, pushing for consumer protections, and refusing to be hypnotized by the stability story when it's used as a blank check. It's reading the terms, filing complaints when companies violate rules, voting in local elections that actually regulate banking and housing, and not letting complexity bully you into silence. 3 is positioning. This is the option people hate because it sounds cynical, but it's also honest. You learn where the center is and you stop standing in places that get crushed when the crowd runs. You structure your personal finances so you're not forced to make decisions at the worst moment. You hold assets you can actually hold through stress. You build skills and income streams that don't die the second credit tightens. You're not exploiting collapse, you're refusing to be the easiest casualty. And listen, none of this is financial advice. It's a map of incentives. It's a reminder that panic is a human behavior, and the system is built around that behavior, not around your hopes. So here's my question for you. I want real answers in the comments. If another 1907 style moment hit tomorrow, who do you think would be on the save list in 2026, and who would be quietly left out? Don't give me names, give me categories: households, small businesses, regional banks, tech, real estate, whoever you think gets oxygen first. And if you want the next episode, we keep following the same pattern because it doesn't stop at banking. It moves into how modern power hides behind normal operations until the night the lights flicker. If you're still here, you're exactly the kind of viewer I make these videos for, so subscribe. Not because it helps me, because once you see the structure, you start catching it everywhere, and I'd rather you notice it before it notices you.